Hi, I'm Steve LaFrance with Blakely Financial. 4 weeks ago, trading in August had a rocky start as headlines regarding labor data and the yen-carry trade dominated the news cycle. Yet stocks traded higher for the month despite the early sell-off. The S&P dropped over 5% in the first week after unemployment rose to 4.3% in July. However, markets quickly stabilized and climbed throughout the month. The S&P recovered all its losses, ending the month just less than 1% below its all-time high from mid-July. The Nasdaq lagged the broader market while Treasury yields fell for the second consecutive month, driven by expectations for deeper rate cuts in response to rising unemployment. Bonds traded higher for a fourth consecutive month as investors rushed to lock in current yields ahead of the first interest rate cut. Investors actually expect the Fed to start cutting interest rates at its next meeting on September 17th. Jerome Powell signaled the move last month's Jackson Hole conference by saying, quote, "The time has come for policy to adjust. The direction of travel is clear and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risk," end quote. It was the Fed's clearest policy signal since it last raised interest rates 14 months ago. The Fed's transition to cutting interest rates comes as its focus shifts from lowering inflation to supporting the labor market. Since the last rate hike in July 23, inflation has dropped from 3.3 to 2.9% as measured by BLS and dropped from 2.7 to 2.5% as measured by BEA, while unemployment has risen from 3.5 to 4.3%. The Fed is more confident that inflation will return to its 2% target, but is concerned about the overall health of the U.S. labor market. The key question is how much and how quickly the Fed will lower interest rates. Investors anticipate that the Fed will cut rates by approximately 2% through the end of 2025, but the timing and amount will depend on the economy's path. A weaker economy would justify more rate cuts, while a stronger economy would likely lead to fewer rate cuts. That is all for now. Stay the course. We'll continue to provide timely updates, so enjoy the transition to fall. Take care of yourselves, and thanks again for your trust and confidence.